Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Omar Khan. Thanks for being on the show, Omar.
Hey, thank you very much. Great to be back.
Yeah, and we're so grateful to have Omar on the show. He's a wealth of knowledge, in the syndication business. He's very experienced, and we've had him on. He's been on show 05, WS120. You can hear more of his background and how he got into the business there. And we've talked about some specific subjects, and whether it's the market, how to find a market and show WS60, and then your team, who needs to be on your team, or a few of the team members, and how to develop those relationships in WS90. So we hope you'll go back and listen to those shows if you haven't heard those already, because Omar just gave some great content and helping you get into the business. But today we really want to focus on the asset management side. And we haven't had many guests talk about this yet. And so I'm anxious to just really ask some questions and just hear Omar's take on how to do asset management, executing the business plan, what that business plan needs to look like, and how and when, what to rehab, just numerous aspects of that we need to know. And so Omar, why don't you again give us just a brief intro about your background and getting into the syndication business, and let's get right into the asset management.
Cool. So guys, I've had over 10, 12 years of asset management experience within real estate and commodities. We've structured and advised on $3.7 billion plus of capital financing and M&A transactions. We've got a stable of high net worth individuals and entrepreneurs who are investors in our multifamily syndications across the U.S., but we're primarily focused in Texas, Florida, and Georgia. And now we're talking to the great Whitney Sewell.
Well, thank you, Omar. So, Omar, let's get into what asset management is. What is that? And let's get started. And somebody that's just getting into the business, what do we need to know about asset management? What is it?
Well, what you need to know about asset management is that, once you raise the money, once people have been generous enough to sign off on your loan documents, if you're in that stage, when you've got partners, all that jazz, money's in the door, you won the deal, now what? Because now comes the hard part, right? So that's what asset management is. Because what happens is a lot of times people say, well, isn't the property manager's job to do this? Well, yeah, it is a property manager's job to do this, but their money's not on the line. Your money's on the line. So you've got to make sure, like in all businesses where you have employees or partners, that they're working to a schedule. They're working on executing the business plan that you said you were going to do in your fancy marketing presentation and on your Excel spreadsheets. That's what asset management is.
So I guess get us started where should we start? Should we say we've got a deal and this is what needs to happen, or we just closed, or should we back up, even before that we close on a property to really figure out our business plan? Maybe you can help us with that, developing our business plan before we close.
Well, you have to back up even before you get a property. Again, guys, I don't want to beat a dead horse, but like what we talked about in the earlier episodes about having an investment criteria, having a reason why you're doing this specifically, right? Not just, hey, I want to make money. By the way, that's a great criteria, but you got to dig a little deeper than that, right? So before you even get a deal, before you're awarded a deal, because I hate the word using I won the deal, because I'm just very superstitious. I feel till you don't exit out of a deal, you never really won the deal, So before you're even awarded the deal, you kind of have to have a plan, because what's going to happen is, guys, that if you're doing these value add deals, you've got to hit the ground running. So what can't happen is that you run the deal. Now you kind of, spend the next 3 months trying to kind of figure out what your business plan is. That shit doesn't work, guys. And if you are basically behind the 8 ball, it's really hard to dig yourself out of a hole. I'm telling you guys, it is impossible to dig yourself out of a hole. So what you've got to do is know your business plan by unit, by how much, for instance, rehabs you're going to do by unit. When you do these kind of rehabs, how much rent upside are you going to get? Why are you going to get this rent upside? You got to have all these schedules. So, when you have project management, right? And there's like, one of those Gantt charts. You've seen the Gantt charts, Whitney? They use in project management and all that. It would say
yes.
Task 1 takes 2 weeks. Task 2 can start after week 1, but it takes 3 weeks. You have all these bars that kind of decide how you have to do. Literally, guys, that's what it is. It's basically managing a project. How do you manage a project? Well, you've got to know what you're managing. What you're managing is rehab, these downturn of these units, and then you bring them back up to market and you get that sweet extra rent premium, the forced appreciation we all talk about. How are you going to do it? You're going to have all these plans set aside before you even win the deal or get awarded the deal. You're going to have to sit down with your property manager and you're going to have a hard conversation with them. And you're going to tell them, and they're going to tell you also because they're partners, right? You're going to say, look, we need, as an example, let's assume you're buying a 100-unit building and you got to say upgrade 75% of the units, right? So you're going to say, look, Mr. Property Manager, we want to upgrade 75% of the units. This is what we need. So for instance, if you're doing the typical light value add, we call it in the industry, putting lipstick on a pig, essentially what you're doing is you're resurfacing countertops, putting some extra new lighting, just putting some full hardwood blind flooring, improving the general layout and look, but you're not touching the structure, as an example. Let's assume you're doing that. Right? So you're talking to your and you say, Mr. Property Manager, we want to upgrade 75 units. We're thinking we're going to do it in 12 months. So what is 75 plus divided by 12? I should know this. 75 divided by 12 is like 7 or 6.25, right? We want to, on average, upgrade between 6 and 7 units a month. Here's what we're going to do. And how are you going to look that you can even do this, right? Number one, do you have the capacity to do this, right? Because you might not have the capacity to do it, right? No shame in that, but you kind of have to know that. Number two, are you going to do it? You're going to go through your rent roll. You're going to see when each unit comes offline, as in when does the lease expire, right? Because when the lease expires, that's your chance of either not renewing the lease and then implementing a rehab program, or renewing the lease and not implementing a rehab program. So you got to have to know all these things. And then, you're talking to your property manager. They already know these things. You're going to say, hey, can we do between 6 and 7 units a month with these types of upgrades? Because if you just say, can we do 6 or 7 units a month? They'll be like, yeah, we can do it. But there's a difference between saying you can do it and actually doing it. So the clearer your instructions are, the more granular you can get, the more schedules you can provide them, the more feedback you can get, which is actually doable feedback, actually practical feedback. Not can you do it, but will you do it? Okay. Now you sit with your property manager, you talk to them, and they say, yeah, look, in March we can do 7 of these, because what's happening in March, April, and let's do March, April, May, we can do 8 of these because we have all these leases coming offline. Right? But in June or July, we can only do 5 of these. So then you kind of structure all these things beforehand. And all these things, by the way, this asset management thing, this should already be reflected in your underwriting. So then you can kind of understand, where does your revenue ebb and flow? Where does your income ebb and flow? Because one part of this whole value add program is that you kind of have to figure out that you straight up don't run out of cash. Okay? So why do you have to know that? Is because in reality, what's going to happen is, guys, that if you run out of cash in, say, March, and your model says, your underwriting says, well, if you just continue doing everything by, say, December, you'll be fine. Now, on Excel, that looks fine. No harm, no foul. But in reality, what happens is, if you run out of cash in March, maybe by April, people are going to cut you some slack, but that's it. You're done. The bank's going to foreclose on you. No contractor is going to talk to you. Your property manager is basically not going to do their job because they know you don't have money, right? So you never get to the end of the year. You never get to enjoying that forced appreciation. So when you have all these plans arranged beforehand, you know when that punch is coming. You know when you're going to run out of money. And for that, you can prepare beforehand by either raising more money, investing some of your own money, or just staggering out your rehabs the right way.
So how do we know, how much of the property we want to plan, to remodel or to redo? How do we know how many units we want to tackle? Over the whole renovation process, you said 75% possibly, in this conversation, how do we know that it's not 50% or 75% or maybe 100% of the units?
Well, that's a good question. So how you'll find out, there's a couple of ways. Number one is the way you're going to do market research, right? So you're going to find out, is there a demand for these upgraded units in the market? Because what you might realize is, you might upgrade all these units, you might make them look nice and pretty, but nobody's going to pay you extra money. So what's the point of rehabbing and re-upgrading and going through all this pain? So, your market research is going to tell you, first of all, is there a market for rehab units, right? Because if there isn't, It's a very short conversation. You're not going to do this. But if there is, then you take the next step. Then you start figuring out, well, if there is a market, how much extra rent premium am I going to get? Now, you might get $100 rent premium. You might get $200. You might get $25, right? Depending on how much rent premium you're going to get, what we target is that any rehab or any value add item we're going to put in, we're going to get at least a 20% return on investment. But you might be different. You might say it's 30%. Somebody might say it's 15%, right? So you got to have to figure out if you're going to get $100 increase in rent a month, as an example, right? If you implement your value add program, right? So 100 times 12 is $1,200, right? You take 20% of that, and basically you can implement up to $6,000 of value add program within the asset for you to get, say, an extra $1,200 a year or 20% return on investment. Now, if you have to put, say, $10,000, what happens is you'll get $1,200 extra a month, a year, but you put $10,000 into the apartment, which basically means now you're getting a 12% return, right? That makes sense?
Mm-hmm.
Right?
Yes.
Well, maybe it's not worth it now. Maybe you shouldn't be rehabbing all these units, right? Number one. Number two, what you're also then going to do is you're going to have to figure out, guys, do I even have the cash to rehab this? The market might support it. You might be getting a 50% return on investment. But guys, the story is, look, if you don't have the money to rehab these units, well, you don't have the money. So what are you going to do about it, right? Then you kind of figure out, if you don't have the money, can I raise this money? Can I talk to my equity sources, my KPs, all these people to say, hey, we see all this stuff. Here's our plan. Would you like to invest some more money into the deal, right? So you got to do all these things before, because what can happen is that you get awarded a deal, you start the business plan, and then 6 months into this thing, you realize, all right, I'm out of cash. What do I do now, right? Because what's going to happen is you're going to have to tuck your tail and go to your existing investors, as an example, and they're going to be pissed. They might tell you to, some choice words, and they might, politely tell you to leave. They're not going to politely tell you, but let's assume they politely tell you to leave. Or they might even invest some money, but they're so annoyed at you that you didn't look at these things coming that they're never going to invest with you again, right? So a lot of times it's better to just take the pain up front and raise all this money up front. So yeah, is it going to take you longer? Do you have to talk to more people? Yep. But it beats the massive amount of headaches and pain you're going to have to take when 6 months into this project to realize, all right, I'm out of cash now. What do I do?
I really appreciate that, Omar, breaking that down. But going into this, you mentioned it earlier that talking with a property management company, and some people say, well, that's their job, isn't it? Well, after we've got our business plan in place, we know how many units, what months, we're going to be renovated. We know we're going to try to do 75%, of the units, we're going to return that many. So, how much of this process is handled by the property management company as opposed to, what we are doing?
Look, so as the asset manager, you're overseeing all these people, right? So a lot of times the big property management companies also have construction management attached to them. So there's pros and cons. The pros are that the property manager, who is, let's assume, managing 10, 20, $40,000 units, they probably have a lot more experience in these kind of projects than you do. Number one. Number two, because they're doing so many of these projects, they get more preferred pricing, right? So if you and I, as an example, have one building and you go to a contractor and whatever rate you're going to get, well, the property manager who has 500 of these buildings is going to get a better rate with a better quality contractor, right? So you get to ride on those things. The bad part of this thing is that, well, now you don't know if the property manager actually went out and did open bidding to get all these contracts, or did they just give it to their brother-in-law, right? You don't know this thing. Number two, what happens is, to oversee all this project, the property management company on average charges between 10 to 15% overseeing fee or construction management fee, right? Well, that's a fee you got to pay, because if you don't pay that fee, they're not going to do the work, because their work is managing the property. Their work is not construction management, but they can do it for you for a fee. Now, again, pros and cons. Pros are, well, heck, they're more experienced than you. Cons, you're paying a lot of money for this stuff. So you kind of have to figure it out. Now, why is this important? Why this is important, guys, is because it's your money. It's not the property manager's money. Let's assume the bank forecloses on this property. You've lost your credibility. You lost your equity investors' money. The property management companies just fine. So you can do this the hard way, or you can do this easy way. And the hard way is that you keep making mistakes that you could have avoided, right? The easy way is that you grease the wheels along the way, you pay somebody a little, but then they do the job. As long as it fits into your business plan, you accounted for it, you raise the money for it, and you know what's going on.
So how often does it happen that you have to change, say, property management companies in the middle of a big rehab, and what would that look like?
Well, ideally, the answer is you shouldn't be changing your property management company in the middle of a rehab because you already did a lot of research. But it happens from time to time. Now, how often it happens, for some people, it happens more. For some people, it happens less. And guys, a lot of times what also happens is we see a lot of times investors firing their property manager. And sometimes it's warranted and justified. But a lot of times it's people just have unrealistic expectations. They expect that they've said something and the property manager is just going to wave a magic wand and things are going to happen. Guys, delays always. There has not been a construction project in the history of mankind, I think, where a delay hasn't happened. Okay? It's just bound to happen. There's so many moving parts. So being in constant communication with your property manager, and they should, by the way, they should also be in constant communication. It shouldn't be a one-way street. It should be a two-way street. As long as it's a two-way street, people give you enough of a heads up and they have a solid, legitimate reason, right? Now, if it's a one-off, it's fine. If it happens every 2 days, right? And if these are completely avoidable things and the guy doesn't even give you a good excuse, then maybe it's time to fire the guy, right? But if they have a legitimate excuse, let's assume a hurricane ripped through the town or 3 of their property crew died. By the way, this is a real story, right? Well, that's a pretty legitimate reason because you can't account for 3 people dying, right? When they were just healthy. So as long as you have a legitimate reason, as long as your expectations are realistic, and always realize, guys, it's a pain firing property managers, especially if you didn't do your job researching these guys up front, then it's on you. It's a pain firing property managers. It's just an administrative, it's a massive inconvenience. So ideally, try to not fire them during the value add process. Try to find an amicable solution. You might not win 100% of the battles, but as long as it's 50-50 or 60-40 in your favor, spite the bullet, take the pain, learn the lesson, and don't do this mistake again.
So before we have to go, Omar, let's talk about, how do we know we're bringing our asset up to the market standard but also by spending the least amount of money?
Well, that's a good question. A lot of times you only know this in hindsight, number one. So that's the secret nobody tells you about. But what you also know is, guys, for instance, if you're buying a property, like we said in the earlier episode about our investment criteria, rents are already 10 to 15% below market, right? So I know I've got that 10 to 15% cushion there. Let's assume I've done my market research. And a lot of times these things you can get from brokers because they have boots on the ground knowledge, property managers, and you don't even have to talk to your listing broker. I'll give you a good example. A lot of times what we do is, even when we're looking at a property in any city, we've got multiple brokers, right? Because brokers are in the business of, developing a relationship, keeping a relationship with you. They're in the sales business. A lot of times how we test the listing broker is that we go to one of our other broker contacts who we have a good relationship and say, hey, Greg, or hey, Mark, hey, what do you think about this asset? What do you think is the rent premium we're going to get here? What's the story here? Guys, it's a really small world. It doesn't seem like it. It doesn't feel like it. It's a really small world. All these brokers, they know all the deals that the other guys are working on, because they were also pitching their services for those deals. So a lot of times how we can find the story is just by asking 3 or 4 or 5 other contacts. Then you can use industry databases like CoStar, Axiometrics, Yardi, Reese, all those things to get a better idea. But at the end of the day, guys, a lot of times you can get, say, 80% of the way there, but there's a lot of luck and a lot of planning involved in these things. So it's a combination of luck and planning.
So, Omar, what else should I be asking about asset management that somebody needs to know just getting in the business that maybe I hadn't thought of? What else can we tell them so they make sure and they're prepared to do it well?
Well, look, I think a lot of this stuff you only learn with experience, and even people who've been doing it for 20, 30 years. Some of my mentors, they keep telling me, look, man, oh, I saw this new guy doing something, some young guy doing something. I really picked that up. Or I saw this older guy doing something. So you're always learning, number one. So you have to be a constant student, and that learning thing never stops. Okay, because the market is just evolving all the time. But number 2, guys, this is a very unsexy topic that nobody talks about on podcasts, because it sounds very sexy to say, oh, I raised $2 million. or I did this, or I won that deal, right? It doesn't sound sexy because like that Arnold saying, the bod Arnold, Schwarzenegger, he said, everybody wants to be a bodybuilder. Nobody wants to lift the weights. Somebody's got to do the work, guys. This is really unsexy, but if you don't know this, or if you don't know the right people who can do asset management, you're dead in the water. You're dead before the game even starts. So take some time to understand this process. If you don't know it, get the right mentors, find the right people, find partners who can do this for you, and get it done. Don't rely on hope and prayer, which the vast majority of people do.
Omar, you've been a great guest, and I appreciate all the content you're able to provide every show that we've done. And tell the guests or listeners a little more about how they can get a hold of you. And then also, I want you to put a plug in there about the deal analyzing software that you all have created.
Cool. So I'd love to do that, Whitney. So my email is Omar, OMAR, at Boardwalk Wealth, BOARD, walkwealth.com. That's Omar at boardwalkwealth.com. You can email me, like I said in the earlier episode. If I don't know the answer to a question, I'll be happy to connect you with people who don't know the answer to those questions. You can also go to our website at boardwalkwealth.com, BOARD, walkwealth, that's one word.com. You can sign up for our newsletters. You get to find out about our deals, all the cool stuff we're doing, all the freebies that we give out. And then if you're so inclined, you're really in the business, you want to get to understand asset management, underwriting, all of those analytics stuff, we're launching a software company. It's called Deal Analytica. Hopefully it should be launched by the time this airs. You can go to our website. It's www.dealanalytica, ANALYTICA. That's one word, dealanalytica.com. You can sign up, you can subscribe, and you can basically get all the tools that the pros use for a fraction of the cost, guys. Because a lot of these tools, if you're at the investment bank, hedge fund, private equity shop, you're paying a couple of $100,000 a year just to even get the basic subscription for a lot of these tools. So what we did is we created a software, and you don't have to pay all that stuff. And this is stuff that we use in our own business.
That's great, Omar. Thanks for telling us, how we can get in touch with you. And I hope the listener will contact you. You're a wealth of knowledge, and I encourage the listeners to get on the Facebook group so you can ask Omar questions, and that way we can all learn this business together and improve our business together. So anyway, thanks again for listening today, and we will talk to each of the listeners tomorrow.
Thank you, Whitney. Great honor to be here.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.